Welcome back to the deep dive. So you're working hard, right? Maybe a marketing manager, maybe running a department, perhaps you're a dozen, or mentoring clients. Point is, you're highly educated, you're successful.
Yeah, you're generating significant income.
Exactly. But then that pay slip arrives. And, the reality of German taxes hits. We're talking hitting that 42% marginal rate.
Plus the solely.
Plus church tax for many. It feels like almost half your earnings just evaporate. Gone before you touch it.
Well, it's not just a feeling, is it? That's pretty much the reality for high earners taxed on labor. And that leads us straight to this paradox everyone talks about.
The Warren Buffett thing.
The Warren Buffett paradox, exactly.
Yeah.
How can one of the richest guys in the world pay, effectively, a lower tax rate than his secretary? Sounds wrong.
It does, and that's really the core question we're digging into today for you, the listener. We've gone through a pile of sources. Piketty, Taleb, Kiyosaki, Dalio, Buffett himself.
And the message, honestly, it's surprisingly consistent. The system isn't really broken. It's actually working exactly the way it was designed to work.
Right. So our mission today is to kind of unpack that operating manual, the financial machine's instruction book, if you like.
We found basically 5 big ideas, 5 livers that kept coming up. Number 1, the system rewards capital, not labor. That's fundamental.
Okay. Number 2?
Financial education. That's your real insurance policy, not just, saving a bit. 3, structure. Like having company. That's probably the biggest lever you have.
Structure. Okay. Got it.
4, smart debt is a tool, not always a bad thing. And 5, aim for anti-fragility, not just optimization. We'll get into what that means.
Sounds like a plan. And maybe we kick things off with Robert Kiyosaki. He has that really blunt quote.
Oh, yeah, the classic. The poor and middle class work for money. The rich have money work for them.
That's the pivot, isn't it? Especially here in Germany, moving from just working for money to having money work for you.
Absolutely. Let's start there.
Okay, section 1. The system rewards capital.
And for this, you really have to look at the math. Thomas Piketty nailed it. He gave us that simple but powerful formula, RG.
Right. R is greater than G. Explain that for us.
Okay, so R is the rate of return on capital. Think investments, stocks, real estate, what your money earns when it's put to work.
G.
G is the rate of economic growth. Think GDP growth, which is closely tied to how much wages generally go up.
So if the return on owning stuff, R, is consistently higher than the growth of the economy and wages, G.
Then wealth inequality is an accident. It's baked into the system. Capital compounds faster than labor income grows. It's just math.
And in Germany, this isn't just abstract theory. It's right there in the tax code.
Oh, absolutely. It's explicit. If you earn money through labor as an employee or self-employed,
you're climbing that progressive tax ladder, quickly hitting 42%, maybe even 45% at the very top.
But if your income comes from capital dividends, capital gains from investments.
Flat tax. Abgeltungssteuer. 25%, basically. Plus solely? Okay, but still.
Exactly. Forget the small print for a second. Just compare 42% versus 25%. That's a 17 percentage point gap.
Wow. 17 points.
That gap is the government's loudest, clearest advice on where you should be getting your income from. It's practically screaming, stop earning just through work, start owning assets.
Which loops us back perfectly to Kiyosaki again, his whole thing about assets versus liabilities.
Yes, this is crucial. An asset puts money in your pocket. Think a rental property bringing in rent or a stock paying dividends.
And a liability.
Takes money out of your pocket month after month.
Like the mortgage on the house you live in or the car payment.
Precisely. And this is where, sometimes highly educated people get tripped up. They buy the big family home, the nice new car.
And call them assets because they have value on paper.
Right. But functionally, they drain cash, maintenance, non-deductible interest on the home loan, insurance, fuel. They're liabilities consuming your income.
So the game isn't just about earning more money overall.
No. It's about changing the source of that money. Accumulating things that generate cash flow, not things that just consume it.
Okay, that makes sense. But this all happens within a bigger economic picture, right? Things go up, things go down.
Exactly. Which brings us to Ray Dalio and understanding the economic machine.
Right. Dalio says it's not just random chaos out there.
Not at all. He argues the economy is basically a machine, driven by transactions and fueled massively by credit and debt cycles.
Credit, so borrowing money.
Yep. Credit lets people, companies, even governments spend more now than they actually earn.
Yeah.
Your spending is my income. If you borrow and spend, my income goes up.
Which means maybe I can then borrow and spend more.
Exactly. That's how booms get going. It's all interconnected through credit.
And Dalio talks about two main cycles.
There's a short-term one, the business cycle we sort of feel every 5 to 8 years. Boom, then maybe a slowdown or a recession.
Okay, familiar.
But then there's the big one, the long-term jet cycle. This plays out over like 75 to 100 years, generational shifts.
Wow. And where are we now, according to him?
Well, the argument is we're likely quite late in a long-term debt cycle. Lots of debt globally.
Okay, so what's the actionable insight there? If credit drives things short term.
The key is this. Productivity, making actual stuff, improving things that tends to grow sort of steadily, linearly. But debt can grow exponentially, faster.
So credit dominates the short run.
Right. Which means, especially now, you have to be incredibly careful with debt. Use it like a scalpel, not a sledgehammer.
Only use it productively, you mean?
Exactly. Only take on debt if it's good debt. Debt used to buy an asset that will generate more income than the debt costs, like financing a rental property, where the rent covers the mortgage and then some.
But never consumptive debt.
Never. Don't borrow for holidays, fancy dinners, the latest gadget. That's just digging a hole. Use debt to acquire cash-flowing assets, period.
Okay, productive debt only. Got it. Now let's get really tactical for our listeners in Germany. The legal structure piece. You said this was maybe the biggest lever.
It really is. This is where you move from just reacting to the tax system to actually using its rules. It's about the GmbH, the limited liability company.
Right. Contrast the self-employed person versus the GmbH owner.
Okay, self-employed or freiberuflich, you earn, say, 100 euros. The tax office takes its chunk first, maybe 42 euros. Then you get to spend or save what's left. Tax first, spend second.
Standard. Punishing, but standard.
Now the GmbH, the company earns 100 euros. First, the company deducts all its legitimate operating expenses, rent for the office, salaries, software, travel for business, training, all that stuff comes off the top.
Okay.
Then the company pays tax on the profit that's left over. Spend first on business expenses, tax second.
That's simple reversal. That's the whole game.
That's a huge part of it. It's the difference between Kiyosaki's ES, employee self-employed quadrants, and the BI, business owner investor quadrants. It's the trick Buffett uses. Every major corporation uses it.
Let's put some numbers on it. Say 80,000 euros profit before tax in a year. Self-employed.
Self-employed, you're probably looking at around, 35,000 euros in income tax and related stuff, pushing that 42% effective rate.
Okay. Now, the same 80K profit, but inside a GmbH.
Inside the GmbH, the profit is taxed differently. It's subject to corporate tax, Körperschaftsteuer, which is 15%,
Yeah.
plus local trade tax, Gewerbesteuer, which varies but averages around another 15%. So roughly 30% total tax on the company's profit.
So 30% of 80,000 is 24,000 euros.
Exactly. Compared to the 35,000 the self-employed person paid.
That's 11,000 euros less tax every year just by having that GmbH structure.
Just by changing the legal wrapper around your business activity. It's significant.
But hang on, people listening might think, okay, 11K is nice, but GmbHs sound complicated, accountants, paperwork, compliance costs. Is it worth the hassle?
That's a fair question. And the sources we looked at suggest a tipping point. Generally, somewhere between maybe 50,000 and 70,000 euros in annual profit is where the tax savings really start to clearly outweigh the extra admin costs and complexity.
So around that level, it's worth investigating seriously.
Definitely. But the immediate tax saving isn't even the biggest advantage. The real power move is something called Thesaurierung.
Okay, fancy German word. Break that down. Thesaurierung.
It basically means reinvestment or retaining profits within the company. You don't take the money out immediately.
So the GmbH makes 80K profit, pays its 24K, 30% tax. It has 56K left. The Thesaurierung means?
It means you leave that 56K inside the GmbH's bank account, and you use that money, owned by the company, to buy more assets, maybe stocks, maybe another property, maybe bonds, all held by the GmbH.
Why is that better than just taking the profit out?
Because if you take it, if you do an Ausschüttung distribution to yourself as the shareholder,
tax number 2 hits.
Bingo. That distributed profit gets hit again with the 25% flat tax on capital gains, the Abgeltungssteuer. It's taxed first at the company level, 30%. Then again, when it comes to you personally, 25%. Double taxation.
Ouch. So the smart play is keep it inside the GmbH, paying only the initial 30%.
And let that larger chunk of capital, 70% of the original profit, not the 40-50% you'd have after double tax, grow and compound within the company structure. You build the company's asset base.
You become a company that owns things, not just a person earning a salary.
That's the essence of it. Shifting from working for money to owning assets within a tax-efficient structure.
Okay, powerful stuff. Now, shifting gears slightly, We've talked structure, taxes. What about risk? We live in a pretty unpredictable world.
Absolutely.
Yeah.
And that brings us to Nassim Taleb. His big idea isn't just about being robust, meaning you can withstand shocks.
No, he goes further, right? Anti-fragile.
Anti-fragile, meaning you actually benefit from chaos, volatility, randomness. You get stronger when things get messy, like lifting weights makes muscles stronger.
How do you actually do that with investments, though? Seems counterintuitive.
Taleb suggests the barbell strategy. It's about avoiding the dangerous middle ground.
Okay, barbell. Like weights on either end, nothing in the middle.
Pretty much. You put the vast majority of your capital, say 80 or even 90%, into extremely safe, almost boring things. Cash, maybe government bonds, very broadly diversified low-cost ETFs. Stuff that won't blow up.
So, super conservative on one side, protect the downside.
Exactly. Survival first. Then, with the small remaining slice, the other 10 or 20%, you do the opposite.
Go wild.
You make highly speculative, high-risk bets, things with massive potential upside, even if most will likely fail. Maybe early-stage startups, maybe crypto, maybe some niche commodity. Things that could benefit enormously from unexpected events, black swans.
So you're safe overall, but you have exposure to huge potential gains. You avoid the medium risk stuff that might just give you mediocre returns but still carries hidden blow-up risk.
That's the idea. You're positioned to survive chaos with the safe part and potentially profit massively from chaos with the speculative part.
Interesting. And how does this mesh with someone like Buffett? He seems much more about avoiding risk altogether.
Well, Buffett's famous rule number 1 is never lose money. Rule number 2 is never forget rule number 1.
Classic.
But his way of applying that isn't just being timid. It's about radical discipline in managing risk you do take.
How so?
2 key things. First, his circle of confidence. He only invests in businesses he truly, deeply understands. If he doesn't get it, he doesn't touch it. Simple as that. Reduces unforced errors.
Makes sense. Don't play games you don't understand.
Second, the margin of safety. He tries to buy assets for significantly less than what he calculates their real intrinsic value is.
So buying $1 for 50 cents.
Kind of. It gives him a buffer. If things go a bit wrong, if his analysis was slightly off or the economy dips, he still likely won't lose money because he bought so cheap.
And the third element for Buffett is always time, isn't it?
Absolutely. His preferred holding period is forever. He lets compounding do the heavy lifting over decades. Ignore the noise, ignore the short-term cycles Dalio talks about.
Which ties into that other Buffett quote about the stock market transferring money.
From the impatient to the patient, yes. Patience is the ultimate advantage if you've picked well and bought with a margin of safety.
Okay, so we've covered a lot. Piketty's math, Kiyosaki's mindset, the GmbH lever, Taleb's barbell, Buffett's patience. Let's try to synthesize this into a roadmap for someone listening.
Right, bringing it all together. The goal, remember, is moving towards Kiyosaki's B, business owner, and I, investor, quadrants.
Yeah.
Decoupling income from time.
What are the first immediate steps someone could take, like today or this week?
Okay, 3 concrete things. 1, audit your cash flow. Seriously, forget net worth for a minute. Get a piece of paper, 2 columns. Assets, what puts money in, versus liabilities, what takes money OUT. Be brutally honest.
If that assets column looks bare.
You know exactly what the mission is.
Yeah.
Fill that column.
Okay, step 2.
Start an ETF SPAR plan, an automated savings plan into a broad, low-cost index fund, like the MSCI world. Even if it's just 500 euros a month to start, automate it. Set it and forget it. Removes emotion, forces discipline.
Gets compounding started. Good. Step 3.
The GmbH check. If you're self-employed or run a small business, book that appointment with a tax advisor, a steuerbrater, who understands GmbH as well. Find out your specific threshold. Are you paying 42% tax on income that could potentially be taxed at 30%? You need to know.
Crucial intel. Okay, those are immediate actions. What about the medium term?
Leverage. Using that good debt we talked about? Once you have the savings habit, maybe the GmbH structure sorted. The next big step is often using smart leverage to acquire your first Vermietate Immobile.
A rental property.
Yes, because in Germany, the interest paid on the loan for a rental property is tax deductible against the rental income. It's a state-sanctioned way to use debt to build assets and reduce tax simultaneously.
It's using the system's rules.
Exactly. Maximize earnings, minimize expenses, especially tax, legally. Invest the difference consistently, use smart leverage where appropriate, and let time and compounding do their magic. Over 15-20 years, the passive income from those assets can eventually cover your living costs. That's the formula.
So, wrapping up, we've got the operating manual, Kiyosaki's asset focus, Piketty showing why capital wins, RG, the GmbH as the German tactical tool, Dalio giving context with cycles, Taleb teaching anti-fragility, Buffett preaching patience and discipline.
It all points one way. The German tax system, like many others, isn't really built to reward the hardest worker in the traditional sense. It's structured to reward the owner of capital. That's just the reality.
It's not about fairness, perhaps, but about understanding the rules of the game.
Exactly. The machine is real. The rules are written down. You can choose to keep being the high-tax employee or self-employed person, the 42%er.
Oh.
Or you can start taking steps to become the capital owner, the investor, the business builder, operating within that more favorable 25% or 30% tax environment. The choice is yours.
And maybe the final thought comes back to Kiyosaki, or that old proverb he often uses. The best time to plant a tree was 20 years ago.
The second best time is now.
So the question for you listening is, what's the one thing, just one tangible action you can commit to today to start shifting your financial life, even just a little bit, from that 42% quadrant towards the 25% quadrant? Don't wait for the system to become fair. Start building your structure now.